Thank you all for joining us this morning. This webinar is going to be about the EPA RVOs and our BTC survey webinar. John will be taking you through this presentation. John is our senior analyst here at the Jacobson in a biofuels vertical. And John, would you like to take it from here?
A quick check-in. I want to sort of preface, obviously, we set up a hopeful date here this morning around the timelines that are in play, especially in relation to the BTC right now. At present, we've not got a ton of information coming out of Washington, D.C., I would argue, in the last sort of 36 hours and the first half of this week. There was obviously appropriations meetings, and I think what all we're hearing as of this morning are very positive things. A lot of our information is from the ag side in those years in DC. But as of this morning, we're hearing very positive things, especially from the Grassley camp. At the moment, I think the expectations are that there will be a 2018, 19, 20 package, and that is seen as the most probable for the market. I think there continues to be talks of a possible retreat to just an 18-19 as kind of a worst case scenario. But we hear less talk about the sort of higher case scenario of a multi-year package that had been talked about across the way as well. Timeline now in place. I think many are hopeful for some clarity on this by the weekend and by Friday. We're hearing this morning could slip in through the weekend, but could be as soon as Monday versus sort of rolling up to, later in the week and further up towards the holidays.
Okay.
So unfortunately, nothing too timely this morning to update at the moment, but wanted to talk a little bit about what we see cause and effects of this playing out here across the next week, especially around the holidays. So obviously, the BTC passage, as expected, potentially the 2018, 19, 20 package. We see a pretty significant void at the moment in the Q1 sort of feedstock market, especially in relation to normal biodiesel production. So I think we recently saw, a decrease here at the 2019 numbers through the EIA reports of about 10% on the biodiesel. And we've thought and looked at from modeling that could expand further into sort of a 20 to 25% range in the Q1 period now on the biodiesel production numbers. At the moment, the Jacobson is seeing obviously reduced D4 into Q4 coming out of biodiesel. At the same time, some of that is obviously ramping in renewable diesel, and that's a story we continue to see. But with the BTC passage, obviously all of this feedstock is emboldened, and near term, I think it immediately triggers fairly aggressive Q1 buying and obvious calendar year 2020 buying of all feedstocks. I think there's an expectation that low CI feedstocks have not been hit quite as hard, that there's been a little bit more of a back off on virgin veg oil. However, expect strong demand to surge immediately as a reaction of the BTC passage. I think prompt gallons especially, but for calendar year 2020. As far as new projects, there's a lot of talk about the future demand on all of our feedstocks here. And obviously a lot of buzz around new processing technologies for these feedstocks as well. So with the BTC passage of 2018, 2019, and 20, we expect that a lot of these projects, whether it be the independents or the more in-house ones that are happening as more of a compliance and economic driven decision, we expect those projects to be emboldened by the BTC passage and for anything that's operating on a side burner to potentially come off outside burner and for those projects to kind of move forward more aggressively on those timelines. Last thing is where a fresh surge of capital goes into the market, you've got quite a bit of that going into agricultural companies. And that surge of, I would argue, biodiesel revenue is going to be looked at, I think, for other infrastructure ideas, many of which might be with an eye to that same new project, renewable diesel co-processing development we just spoke about, new oil refining capacity and infrastructure to meet potential sort of Western North American facing demand that's coming at the market. And so that fresh surge of capital, at the moment, you've got 2018, you've got $2.646 billion wrapped up right here in the BTC. And in 2019, we estimate about a $2.8 to $2.84 billion pot. So we're talking $5.45 to $5.49 billion wrapped up in the current BTC situation. And that's going into, we've talked to a lot of different people and tried to work on a list and some estimates of where this money is distributed. It certainly goes in very large amounts to about a dozen companies, and that's a pretty easy list to make. But, it's not that widespread. There's some real concentrated large pieces of this money going in to companies, and we expect emboldened use of that towards future sort of renewables projects. And again, whether in the ag companies, it's veg oil, pre-treatment processing, refining, that type of stuff, whether it's new projects, within the refinery gates around renewables and the hydrotreating of these feedstocks, expect the BTC to embolden that. On the opposite side of the coin, the option I think most would argue is we see alternatively a continuing resolution, and that could skip as far into February 2020. Obviously, that puts us into a very unprecedented land of a third consecutive lapse year. Expect to see that 20 to 25% decline. Now, again, when we saw this sort of 10% sign from the recent EIA data, we do know some of that feedstock is likely headed over into the renewable diesel bucket. And that trend's been underway. Everybody who's watching EMTS is seeing that, renewable diesel, 17, about 600 million, 18, 615. 2019, we're estimating upwards of, I think, 915 million. So major jump up year on year, 18, 19. And so obviously we're starting to see feedstock transfer over into that renewable diesel production a bit here. And that's a piece of the story. But the biodiesel side, we expect could potentially really get hit in Q1 if the BTC gets kicked to February 2020. That uncertainty we expect to land fairly squarely on that production. With renewable diesel still fetching such really strong returns thanks to the California market, we expect that to see obviously less of a hit, if any, quite frankly. If the BTC is also kicked, you've got a D4 RIN market that in theory, from a market structure side, should begin to perform and adjust. As we've seen in the past, though, this could be gradual. We've seen these market adjustments painful at times in the way they react slowly. So, across a January, February could be a possible thing. The Jacobson has trot across the past year, and probably a few people on this call have been extremely helpful to us in trying to crack the code on the BTC market. There's sort of this extrinsic and intrinsic value of the BTC within, especially the biodiesel, but also the renewable diesel market. And we've begun to try to really capture that and look at it as a market and do our best to track that. So again, everybody who's helped us out along the way with that, we appreciate your feedback and your insights on it. A natural, I think, result of the can being kicked down the road into a continuing resolution in February for the BTC tax credits is some further sale, potentially some liquidation of BTC. That could be a knee-jerk reaction here. We've seen that in moments a bit across the last 6 months, especially, probably a bit increasingly. But this sort of moment, I think year end, year two lapsed, it's slipping into the third year. This may be a natural result of that, could be a little bit destabilizing. If anything, we'd seen that credit market, in our view, build over the past sort of 6 months, really around the point, 6 weeks, really about around the point where Neil and Grassley started to kind of sort of come together and gel, and the early signs of the package really began to approach. Getting back to that a little bit, where we are at the moment here, I do think that there was an excellent article on the Wall Street Journal about a day ago, and it talked a little bit about the tax extenders package and a little bit about what was going on between the Republicans and the Democrats and the key sponsors of this. And I think the BTC is obviously the first shoe to drop here. Followed by that, you're going to have sort of RVOs. And we see that news coming. And I think, that is a challenging one as well for the market. But I think the expectations and the anticipations are a bit more clear. So as far as, Q1 feedstock pricing, D4 RIN pricing, we see the big market pivot point right around the curve here coming with the BTC. We're reporting and hearing that could be as soon as the end of this week. So that's end of the day tomorrow. Hearing some reports very early this morning, things could play out through the weekend, but we'd likely hear something by Monday. So that's kind of the up-to-date report from the Jacobson. Thanks for your time and joining us this morning. We'll do some questions from here.
Okay, John, we got a few questions right out of the gate. If anybody else has questions, please go ahead and submit them in the Q&A section of Zoom. Our first question is biodiesel / renewable diesel cost effective / self-sufficient without the blender tax credit?
Well, I think it's challenging without looking at each fuel's sort of spot in the cost curve. But certainly what we see sort of from the numbers is that you've got a high amount of renewable diesel moving itself into the California market, where there's this very strong demand for that product. And renewable diesel producers in that market are able to capture a lion's share of the sort of margin of that. And at the moment, that appears to well exceed the dollar per gallon tax credit. And so it's sort of non-necessary, but obviously would be welcome. Jacobson does something in a couple different places where we talk about renewable diesel versus biodiesel economics. So certainly on our website, there's a few places to explore where we get into this deeper. But at the moment with biodiesel, you've got similar economic buildups, but deeper discounts to move that same gallon into the California market, and thus a significantly less margin, and tends to be quite a bit more exposure to the tax credit. So depending on your sort of fixed and variable costs of that biodiesel asset, it's much more borderline there.
Okay. The next question we have, John, is what if the RVO numbers increase and there's no blender credit, and no blender credit is set or dropped completely?
I think we see what's kind of in motion with the slowdown in biodiesel as a reaction to really the BTC, right? So I think a stronger RVO trajectory would really be a great scenario. And although nobody necessarily wants to see the rug pulled out on the tax credit, it's that kind of environment with strong RVOs that a tax credit could disappear, a phased out one, a de-escalated out one, with that type of market certainty in the backdrop. Ultimately, if a tax credit's gone, RIN should perform. market structure wise, that is what should happen. And, we're already seeing signs of that. The reality is that slowdown in biodiesel production that we're feeling across these markets from the feedstock demand side, it's not generating as many RINs. Those RINs are no longer available. And yes, there's some more generation, obviously, in renewable diesel. Some of the refiners are beginning to generate them for themselves. There are other developments, that's still moving in that direction quickly.
Okay. What, from a legislative schedule perspective, would cause the BTC to come through in February as opposed to other months in 2020?
Yeah, I apologize. I think, that February was a comment made to me this morning. My sense that it wasn't flippant by any chance, but my sense is it's tied more to sort of like past discussions. It could be January. I've not heard any discussions, to be clear, about a continuing resolution. That was simply a what if speculation this morning. I know in past years, having followed the BTC since 2009, there's been sort of that sort of, it's gone past January in the past, so it's not surprising to me to hear that, but nothing formative to that statement. I want to be clear.
Okay. And it looks like we have time for some more questions here, John. Are you okay with a few more?
Absolutely.
Okay. What is the future outlook for Mexico demand for biodiesel and ethanol?
So that's an interesting one. We were just down there recently, and talking to quite a bit of people about that whole boom. And beyond simply biodiesel, it was really a refined products energy boom, where sort of Pemex had sort of a trading entity called PMI Trading that had kind of managed all of the ins and out flows, and that was somewhat disbanded, and all of the private companies sort of fled in and set up offices. And there was talk of biodiesel and ethanol flowing by rail into Mexico, but there was a lot of murky things sort of 3 to 5 years ago when that all opened up around the taxation in Mexico. And we never the biodiesel ARB opened up here and there. There were some certain distribution things granted to certain companies, but that capped volume. So we never really saw that boom the way I think people had hoped to and got excited and behind it. Ethanol, a bit more so. I think being down there recently and taking a temperature on things, we're not seeing as much on the sort of fuel side as real clarity on the low carbon front emerging. I think that's moving at a slower pace and more of in that sort of groundswell global manner. I think what you're starting to see, certainly is on the power side, CFE starting to look at more and more things. And so the demand may come from there. But it doesn't seem like there's anything sort of imminent there. There was sort of this wave of excitement a few years back. We've seen that diminish quite a bit. And we're not seeing any new horizon lines on that at the moment.
Okay. Next question we have here is, why a blender credit versus a producer credit? A producer credit would get the money into the hands of the domestic producer. There is no guarantee a blender's credit will get to the domestic producer.
I think there's a lot of problems with the credit. Having worked for one of the larger biodiesel producers years ago, I think, there's challenges with the structure of this. The problem is, I think sort of 10 years later, it's been so precarious year to year. It feels as if people have been very worried to try to push anything other than just getting the sort of lapse credits re-upped through. And so I think it's almost that simple. There's been some really great thinking about making the tax credit more palatable, about talking about it with a finite ending and in a de-escalating manner over a course of years, like, which should be a really palatable sort of thing to bring arguably to Congress, a way to kind of wean the market off of this. But it feels as if the market just hasn't felt it's had the chance. It's had extraordinary champions like Senator Grassley. We've got Representative Neal now stepping in, and you know, a whole slew of great champions, both sides of the fence.
Another question: if no blender credit is in place, what is your range for RIN values in 2020?
Well, you know, we've seen that market structure, you know, not react as quickly as we've hoped in the past. So we're putting some stuff together out on all that right now, and you'll see some of those scenarios come out in the various offerings of the Jacobson sort of year end. You know, to say that the easy story of it's 66 cents, or, you know, around that 1.5 RIN, or sort of dollar per gallon equivalent into the RINs, is sort of the easy starting point. It getting to there is not likely, obviously, but we see, obviously, you know, 30 to 40 cent move needs to happen to make production go. How quickly the market sees the D4 slowdown, how painful that might be through a January, February timeline, all big questions here.
Okay. And the last question that I have here, John, is there a BTC value that is being traded in the market today, a percentage of the dollar that is being built into the feedstock purchases, perhaps? I know you've been tracking this to some degree, just wondering what the current value is and how it is artificially increasing feedstock prices.
So the last piece of that question, you know, is a really, really interesting point, because inherently it is. You know, we've tried to do our best to kind of cover it. You know, it's been hovering a little bit higher, obviously towards 40 cents across the past few weeks, but it's been, you know, pretty steady in that 30 to 50 cent range for most of the last 6 months. Although, you know, the tax credit has kind of since somewhere around the summer been lumped into this expectation of now where we sit today, like, you know, it getting cleared up in the coming days. So, you know, that value, as far as it trading, yeah, it trades quietly. There's a few brokers that do it. What I'd say most notably and of interest is the surge of kind of interest we saw, and I don't know, I want to say about the November timeline at first, of funds again. Now, we saw this happen in the last couple of years. We're just sort of pure play groups. We're looking at making $5-10 million bets on the tax credit and trying to understand how to be structured into something like that. I think the challenges for groups looking at that, from a risk reward standpoint, ends up being the way to get structured into a deal like that. It has a little bit of kind of hair and complexity on it for people in the end. But what I would say is we've certainly seen a real surge in interest in it, mostly on the buy side, but more market activity than ever before, which is why we've tried to really engage and begin to put some market texture and talk about the market.
Okay. John, do you want to talk to everybody briefly, maybe a quick minute, about the LCFS Outlook report that we're rolling out here that you're working on?
Yeah. So we're, yep, that'd be great. I'll do a little shameless plug here. We've got a first LCFS Outlook report coming out. Genesis of the report is really to look at sort of CARB's illustrative compliance forecasts on what they're expecting out of renewable diesel, biodiesel. And, you know, we've sort of developed at the Jacobson here sort of two alternate scenarios. One is based on what we see is fairly, you know, solid information on new projects coming faster than those CARB forecasts are anticipating. So we're looking at sort of a surge of renewable diesel and co-processing, especially around the sort of 2023 to 25 period. We're looking at how that displaces a little bit from biodiesel and running some S&D around that in California. Then we're taking an even uppercase scenario that then starts to kind of add to that from the 2025 to 2030 timeline, and really focuses on what we see as sort of some co-processing technology coming to the market, um, and sort of an uppercase scenario to that. So that's going to be coming out here in about a week. Going to be kind of a latest offering from the Jacobson. Hope everybody has a happy, great holiday. Thank you.